Imagine the sound of panic. Not a scream, but the sudden silence of banks locking their doors. The growing murmur of a nation losing its life savings. In the early 20th century, this wasn't a nightmare. It was the American reality. October 1907, New York City. The city's third largest trust company had just collapsed. Like perfectly aligned dominoes, other banks began to fall. Savers woke up one day with their savings and went to sleep that night with nothing. Lines formed before dawn. People waited for hours, only to find their savings had evaporated. The cause? A perfect storm of rampant speculation, a lack of regulation, and something even more fundamental. There was no guardian, no central authority capable of saying stop, or of injecting confidence when fear took over. Every bank was an island. Every decision, a leap in the dark. John Pierpont Morgan, the most powerful banker of his time, locked himself in his library with other financial titans. For nights on end, they coordinated emergency loans, using their own fortunes to prevent the system's total collapse. It was Morgan, a private citizen, who saved the American economy that grim autumn. But a question hung in the air like smoke after a fire. What if Morgan had said no? What if he hadn't been there? The answer arrived 6 years later, on a remote island off the coast of Georgia. November 1910, Jekyll Island. 7 men boarded a private train car using only first names. No titles, no formalities. The secrecy was absolute. Among them, Nelson Aldrich, a powerful senator, Benjamin Strong, the future architect of the modern banking system, and Paul Warburg, a financial genius from Europe. For 9 days, away from the eyes of the public and the press, these men sketched the plan for something unprecedented in American history: a central bank. Not an ordinary bank, but an entity capable of stabilizing, of intervening, of being the maestro that was missing in 1907. The secret leaked years later, causing a scandal. Conspiracies were fueled. But what really happened on that island was the engineering of a system designed to answer a fundamental question: how to tame the beast of financial instability. The answer was the Federal Reserve Act, signed on December 23, 1913, by President Woodrow Wilson. But what exactly was born that day? It wasn't a bank in the traditional sense. It was a hybrid, part public, part private. An entity with a dual mission that would sound simple, but would prove to be extraordinarily complex: to maintain price stability and to promote maximum possible employment. 2 objectives that often pull in opposite directions: how to balance growth without inflation, how to create jobs without devaluing the currency. These are the questions that keep the Fed's governors awake at night. The structure created was equally peculiar. At the top, the Board of Governors in Washington. 7 members appointed by the President and confirmed by the Senate. 14-year terms, purposefully long, to insulate these minds from short-term political pressures. But the power is not concentrated only in Washington. Spread across the country, 12 regional Federal Reserve banks, from Boston to San Francisco, each acting as a censor and executor of monetary policies in its region. Boston feels the pulse of technology, Kansas City, that of agriculture, New York, the financial heart, where trillions are traded daily. And at the center of this economic neural network is the Federal Open Market Committee, the FOMC. Here, 8 times a year, 18 people gather in a windowless room in the Eccles Building in Washington. The topic? A single $1 trillion question. Where are interest rates headed? These meetings are not broadcast live. The minutes are published weeks late. But when the doors open and the statement is read, markets in Tokyo, London, and New York react instantly. Fortunes are made or lost in seconds. Because the Federal Reserve is not just an institution, it is the hidden maestro of the world's largest economic orchestra. And its decisions echo far beyond American borders. But maestros need instruments, and the Fed's instruments are both elegant and frighteningly powerful. But how does one entity in Washington actually manage to influence the price of bread in Texas or the cost of a house in California? The answer lies in tools, nearly invisible levers that move trillions of dollars. The first and most powerful of these levers has a technical name, the federal funds rate, but think of it more viscerally as the main sluice gate on a vast reservoir of money that flows through the American economy. When the Fed raises this rate, the gate closes partially. The flow of money becomes slower, thicker, more expensive. Banks charge more to lend. Companies think twice before expanding. Consumers postpone that big purchase. The economy takes a deep breath, slows down. When the Fed lowers the rate, the gate opens. Money flows freely, abundantly, cheaply. Loans become accessible. Companies hire. Consumers spend. The economy accelerates, sometimes too fast. But here is the crucial detail. The Fed does not directly control the rate you pay on your loan. It sets a target for the rate that banks charge each other, behind the scenes, when they lend money overnight. It is in this obscure market, invisible to most people, that the magic happens. When this interbank rate rises, like water flowing downhill, all other rates rise too. Mortgages become more expensive. Credit cards increase their interest rates. Car loans weigh more heavily on the budget. The cascade is inevitable. But raising and lowering interest rates is just the beginning. The Fed has a second tool, more subtle, more controversial, and much more powerful. Open market operations, OMO. Sounds technical? That's because it is, but the principle is almost alarmingly simple. The Fed doesn't turn on a giant printing press. Instead, it goes to the market, like any buyer, and buys assets. Government bonds mainly. Sometimes during crises, even mortgage-backed securities. But here's the trick. With what money does the Fed buy these assets? Where does this capital come from? The answer will make you stop and think. It creates this money out of nothing. It's not physical printing. It's digital. With the click of a mouse, the Federal Reserve credits reserves into the accounts of banks. Money that didn't exist seconds before, now exists. It is an act of pure monetary creation, sanctioned, legal, deliberate. In exchange, the Fed receives the bonds. The banks receive new money. And with this new money, the banks can lend more. To companies, to families, to investors. Credit expands. Liquidity floods the system. This process has a name that became famous and feared during the 2008 crisis, quantitative easing, QE. During crises, when lowering interest rates is not enough, when the rate is already close to zero and can't go any lower, the Fed resorts to QE. It doesn't just buy ordinary government bonds, it buys aggressively. Billions, hundreds of billions. During the pandemic, trillions. The Federal Reserve's balance sheet, the sum of all the assets it holds, was about $800 billion before 2008. Today, it is in the range of $8 trillion, a tenfold expansion in less than 2 decades. But let's follow the path of this money, because the story doesn't end at the bank. A commercial bank like, say, Bank of America, receives these reserves from the Fed. Now it has more capital, more lending capacity. But banks can't lend reserves directly to you or me. So what happens? The bank uses these reserves as a basis to create new loans. You go into the bank asking for a home loan. The bank analyzes your credit and approves it. It doesn't hand you physical cash. It credits the amount to your account. New money created digitally based on the reserves the Fed created. You use this money to buy the house. The seller receives the payment. They deposit it in another bank. That bank now has more deposits and can make more loans. The cycle repeats, expands, multiplies. This is the magic and the danger of the fractional reserve banking system. Every dollar the Fed creates can turn into $10, $20, or $30 in the real economy. But there is a third tool, less used today but historically important: the discount rate and reserve requirements. Reserve requirements force banks to keep a percentage of deposits saved, not lent out. The higher this percentage, the less the bank can lend. Less money in the economy. It's like tightening a belt. The discount rate is the rate the Fed charges when a bank comes to it, desperately, asking for an emergency loan. It is always higher than the federal funds rate. It is the loan of shame, the last resort. These levers, interest rates, open market operations, reserve requirements, are the maestro's controls. But a maestro does not play alone. He interprets, reacting to the real economy, trying to predict the future, balancing invisible forces. And sometimes, the maestro faces a storm that no one saw coming. These levers are not academic exercises. They are the force behind the headlines we read every day. The jobs created or lost, the homes bought or abandoned. To understand the true power of the Fed, we need to look at the moments when it was tested, when theories met the brutal reality of crises. September 2008, the investment bank Lehman Brothers, an institution with 158 years of history, declares bankruptcy. It is not just one bank falling. It is the detonator of a bomb that had been armed for years. Subprime mortgages, loans granted to people unable to pay, had been packaged, sliced, and sold as safe products to investors worldwide. When borrowers began to default, the house of cards collapsed. Banks stopped trusting each other. The interbank market, the very one where the federal funds rate operates, froze. Banks that had billions on Monday couldn't pay their bills on Friday. Panic was not just possible, it was imminent. The Fed, under the command of Ben Bernanke, a man who had dedicated his academic career to studying the Great Depression, acted with unprecedented speed and aggression. First, he lowered the federal funds rate to virtually zero, but it wasn't enough. The rate had nowhere left to fall. So, he pulled the bigger lever, quantitative easing, first round, QE1. The Fed began buying treasury bonds and mortgage-backed securities. Not millions, billions, hundreds of billions. The goal? To flood the system with liquidity, to make the money flow again, to prevent distrust from turning into a total collapse. Did it work? It depends on how you define success. The economy did not enter a depression. Banks did not fail en masse. But the recovery was slow, painful, uneven, and the consequences, we are still living with them. We fast forward to 2020, another type of crisis. Not financial this time, but sanitary, a global pandemic, COVID-19. In a matter of weeks, the most powerful economy in the world was put on a forced pause. Stores closed, factories shut down, planes on the ground. 30 million Americans lost their jobs in 2 months, twice as fast as in the 2008 crisis. The Federal Reserve, now under Jerome Powell, did not wait. It did not hesitate. It opened the floodgates like never before in history. Interest rates? Zero. Immediately. Quantitative easing? Not just billions this time, trillions. The Fed bought $3 trillion in assets in the first 3 months. Faster, more aggressive than in the entire 2008 crisis. But the Fed went further. It created emergency programs. It bought corporate bonds. It supported the municipal debt market. Basically, if there was a market in panic, the Fed was there to stabilize it. The economy recovered, faster than many expected. Unemployment fell. The stock markets hit record highs. But there is always a but. Inflation. That ghost that seemed buried for the last few decades resurfaced. In 2021, prices began to rise, slowly at first, then accelerating. Food, energy, rent. Everything became more expensive. In 2022, inflation reached levels not seen since the 1980s. The Fed had flooded the system with money, too much money chasing too few goods. The supply was broken by the pandemic, the demand inflated by stimulus, the classic inflation equation. And now, the Fed faced the opposite dilemma. How to withdraw this money from the economy, how to tighten the floodgates without crushing the recovery, how to raise interest rates without causing a recession. Jerome Powell began raising rates in 2022, not in small steps, but in aggressive leaps. Half a percentage point, 3/4 of a point. The rate that had been at 0 rose to over 5% in less than 2 years. The fastest increase in 4 decades. Mortgages skyrocketed. Car loans became prohibitive. Companies cut jobs. The housing market cooled. The stock markets fell. And inflation began to yield. But the cost was real. Families lost their dream of home ownership. Small businesses closed their doors. The pain was distributed, and not always fairly. And here we come to the criticisms, because no institution with so much power escapes scrutiny. First critique: the Fed created inequality. By keeping interest rates low and buying assets, it inflated the price of stocks and real estate. Who benefited? Those who already owned assets. The rich got richer. Meanwhile, savers, mainly elderly people living on interest, were punished. Their savings generated practically nothing. Second critique: the Fed generated bubbles. Cheap money led to risky investments. Unprofitable companies received billions. Cryptocurrencies skyrocketed. SPACs, shell companies created just for speculation, proliferated. When money became expensive again, these bubbles burst. Fortunes evaporated. Third critique: the Fed is too opaque. Its meetings are secret. Its decisions often surprise. Economists debate its actions. Politicians attack or defend it depending on the party. But the average citizen feels the effects without understanding the causes. And perhaps the most fundamental critique: the Fed has too much power. A room with 18 people decides the fate of 330 million Americans, and by extension, billions around the world. They were not elected. They are not directly accountable to the people. Should they be? Ben Bernanke, reflecting on 2008, said something revealing. We had to choose between letting the system fall apart or taking actions that we knew would be controversial. We chose to act, and we dealt with the consequences. And the consequences are complex. Did the Fed save the economy? Yes. But did it create new problems? Also yes. Did it prevent a depression? Probably. But did it generate the inflation that came after? In part, yes. There are no heroes or villains in this story. Just impossible decisions, made in real time, with incomplete information. The Federal Reserve remains a maestro in an orchestra that never stops playing. Its decisions shape our present and our future. The price we pay for goods, the rate on our loan, the security of our job, and understanding its music, its high and low notes, its strategic pauses, its dramatic crescendos, is the first step to understanding the world we live in. Because in the end, the economy is not just numbers on screens. It is the lives of real people. And the Fed, with all its invisible tools and hidden decisions, is at the center of that life. The maestro continues to conduct. The orchestra continues to play. And all of us, whether we like it or not, are dancing to the sound of this music. To continue understanding this music and not miss a single beat of our analysis, subscribe to the channel. And now we want to know, what is your opinion on the Fed's actions? Leave your comment below.